Hi, good afternoon. Somebody confirm on the chat if you can see the screen and hear me. Hi, everyone. Thank you very much for taking the time of busy schedules to, and we hope that this session will help gain some insightful knowledge. So, my name is Devaniti Seva, and I am certified equity securities advisor at John Keel Stockbroker. So, before I start off, I'd like to introduce ourselves as to who we are. So, we are actually a part of John Keel's Holdings, which has 70 companies in it, and it's the largest conglomerate in Sri Lanka, diversifying across seven industry sectors. And if you look at some of the brand names, and some of it are like very household names, and especially this is catered to the Nexus members. So Keels, Elephant House, and all those household names are here. So basically, we are from John Keel Stockbrokers, which falls under the financial services sector. So we are a fully owned, we are a subsidiary of John Keel's Holdings. And if you take the Colombo Stock Exchange, it's formed 15 founding members, and we are one of them. And if you trace back to our roots, we've been in operation since 1896 in share broking. So, in terms of our services, what we mainly offer is equity trading and investment advisory. So we at John Keel Stockbrokers, we did this analysis on our active client base, and what we found out is out of the entire lot, it was only 15% were women. And even in that, when we like speak to them, and if we ask them, they would say, "Oh, it's my husband who is investing, and it's not really me." And or it could be a case where they would say, "Oh, it's my son who is operating." So we actually don't see women in the forefront when it comes to investments. So which is why we actually started this She Invest campaign. We launched this last year for International Women's Day, and we actually didn't want this to be something which is celebrated only for the month of March or only for Women's Day itself. We've been very keen on this campaign, and we have been conducting these types of awareness sessions wherever and whenever possible. So, throughout the year, we have made so much progress under this campaign, helping ladies to actually get more confidence into investing in the stock market. So, this She Invest campaign is all about it helps you to educate, engage, and empower to invest for the future. So basically, why do you think women should invest, right? So firstly, it's for financial independence, right? It's very important for us that we do not want to rely on anybody else's income. We like to make our own money. So financial independence is number one. Secondly, wealth accumulation, right? So we may have certain goals in our life where we would want a little lot of money, maybe to travel or build your house or whatever the case may be. So wealth accumulation is very important, and I will also touch upon something called the compounding effect in the later slides. And also, nextly, it's to retire in comfort, right? So all of us kind of look forward to have like a stress-free retirement where we don't rely too much on our children, and we like to follow our passion, maybe to travel, so you can retire in comfort. And overall, if you look at all of these aspects, overall in general, if you see somebody who has actually invested, they are if who has financially stable, right, it overall improves the quality of life as well. So what are we planning to cover today is mainly the concept of saving versus investing, right? So there is a big difference between these two. So as women, I myself, something that we're all comfortable is saving, right? But have we really looked at investing? Is what we're trying to touch upon through this session. And if you all have any questions or any doubts, just keep a note of it. And at the end of the session, you all can put it on the chat, and I'll try to answer it as much as possible. So, as I told you, so all of us are very comfortable in saving money, right? So, we're just going to look through the characteristics and how it differs from savings to investing so that we understand exactly what investing is all about, right? So, in terms of the purpose and the goals, right? So, savings, why we would do is for we might be having some expenses that we want, some planned expenses for short-term financial security and for emergency funds. Those are the reasons why we save money in a bank account. But why do we actually invest, right? We invest money is actually to grow our wealth, right? It's for long-term wealth creation. In terms of risk and return, well, savings, like if you put in a fixed deposit also, it has very low risk because you have a guaranteed return. Just as much as it's a low risk, so it's a comparatively a lower return as well, right? Especially the bank savings and fixed deposits. So currently fixed deposits are also on single digits right now. It's about 8 to 9%. But whereas investing, obviously, it essentially has the risk component to it. So it's high risk and it has also the potential for higher returns. Next is liquidity and accessibility. So savings, of course, we can easily quickly go to an ATM and get our cash. It's very easily accessible, right? But whereas if you put money into an investment, you need to wait for it to grow in capital and many aspects of it. So it's comparatively less liquid than savings. Inflation means it erodes the value over time, right? So, but whereas if for a fixed deposit, if you had kind of locked your money for, let's say, about 5 years and at a lower rate, and if inflation had hit, so you're going to get affected, right? But whereas if you take in investing, stocks can actually potentially outpace the inflation and increase your wealth over time. Time horizon, so basically savings is made for short term needs, but whereas investing is for your long term goals. And compounding effect, I will touch upon this on the next slide. But basically, if you take on savings, it's a very minimal growth. But whereas if you make use of the power of compounding, you can significantly grow your wealth over decades. And the other is the psychological factor, because for savings we feel very safe on it and it's very stress free, right? But whereas for investing, I wouldn't say it's very stressful provided that you have done the right steps, but you need to have a lot of patience for your investment to grow in value. So here I will just explain briefly about the power of compounding, right? So here I have just taken an example of two individuals who has 100,000 each. So basically, individual A has made it a habit to invest 100,000 every year for a period of about 20 years, more than 20 years. So basically, you can see that this particular and the other one, individual B, has started investing at the age of 35, which is 10 years after individual A. He also is going to put 100,000 every year. But you can see because of the compounding effect, individual A has to put only 500,000 only for 5 years, because from there on the interest gets added to it and accumulated and the wealth grows, right? So that is the compounding effect. But whereas if you take for individual B, who had started 10 years after individual A, has to put 100,000 for the next 20 years to cover it up to the amount that the individual A will be receiving in 2060. So the point that I'm trying to highlight here is it's very important that you start very early in life so that you can actually accumulate and grow your wealth over the years. So when it comes to investing, when it comes to stock market is investing essentially, right? So these are kind of like the common misconceptions that we have heard by speaking to people internally as well as externally. So number one is some people actually think you need to be like a financial wizard, like a math genius to invest in the stock market. Well, essentially, that's not the case, right? So you actually need not worry because once you open up an account, there'll be an investment advisor allocated to your account, right? So we can give you the proper guidance in terms of the recommendations and things like that. But what you really need to know is just stay updated because all the news and everything, kind of circulates within matter of seconds, right? So just stay updated with what happens, the current affairs, how the country is doing, and these general facts and figures is more than enough, right? And you will be guided with an investment advisor. We will back you up with a lot of research content. So you really need not be like a financial wizard to enter into the stock market. Then again, secondly, what people think is like investing is like gambling. Well, that is also very different, right? So gambling is purely on luck and it's by chance. You might double your money in 1 minute, the next minute you do again, you might lose everything, right? But whereas in investing, if you take a medium, especially a long-term view, over the years, I can show you figures how the market has performed so that if you are properly doing your risk assessment and that you are doing it with the proper knowledge, you need not worry. And investing, it will definitely grow your money in the long term, right? So it's not like gambling. And the stock market is an exclusive club for brokers and rich people. Again, it's a no. And what I would like to encourage all the ladies is because this Women's Day fell on 8th of March, and this whole month we have made it for you to start investing with an initial investment of 50,000. So we at John Kill Stockbrokers, we get clients on board with an initial investment of 500,000. But what we saw was women are generally a bit risk averse to put in money to something that they really don't know. Once you know, then you are very comfortable and you can increase your investment. But for you to try the waters, to see whether it works for you and to get yourself comfortable with how it works, right? So you can actually, all ladies can start with an initial investment of 50,000. And next is, do you already have to have a lot of money to invest? Well, again, I touched upon the same point. So you can start up with 50,000, right? And essentially, this is not for rich people. Anybody can be rich, provided that you have the proper discipline, you take that proper long-term view to invest. And then what people think is, should I put all my money in the stock market because it will give higher returns? Well, you shouldn't do that as well, right? So you always have to diversify your portfolio in terms of your investments as well. It's important that you put a part of your money in savings, a part of it in fixed deposits, and a part of money that you can set aside for some time, that you can hold it for 1 year or even more than the longer the better. If you can keep it aside and let it kind of grow in value, that's the type of money that you need to put into the stock market. So I'm touching upon a few basic terminology for you to familiarize yourself. So basically, equity, stock, share, all interchangeably means the same thing. It's actually a unit of ownership in a company. Then equity or share portfolio is a collection of different stocks. Share price is actually the current value of a single stock, and target price is what we expect, what is the potential of that company's share price to move up, and what's the expected price is basically the target price. Then again, you might hear when it's news about the stock market, people will say bull market, bear market. So you might, in your head, you might wonder what is this bull and bear market, right? So how you can keep this in mind and remember it is, if you think about a very aggressive bull, the horns up, so that means the market is up, the share prices are rising, right? So that's called a bull market. Bear market means, so if you picture like a bear who's always, the head is always down, so that's a declining share price, right? So the overall performance of the market declining. So that's what you call a bear market. Then liquidity, turnover, and volume. So all these also interchangeably, what it means is the level of activity in a stock. And then we have the stock exchange or the stock market, we say. For us, it's the Colombo Stock Exchange. That is where the publicly held shares are bought and sold. So if you take the Colombo Stock Exchange, so currently we have 284 listed companies with a market cap of about 5.7 trillion. And then there are two indexes, right? So these are actually there to gauge the performance of the stock market. So if you take ASPI, which is called the All Share Price Index, that actually shows the overall performance of the market, right? So if they say ASPI has moved up in 100 points or whatever, that shows the overall performance of all the stocks listed on the CSE. S&P SL20 is actually the top most, the 20 most liquid counters fall under the S&P SL20. And if you take the performance as of 2024, ASPI has performed about 50%, close to 50%. So, which means to say, if you had put money at the beginning of 2024, by the end of 2024, you would have got a 50% return. And if you take the S&P SL20, it's about 58.46% in return just for last year itself. So I'm just showing a few statistics like over the years. Now this is I've taken from 2009. Just give me a second. I'm sorry about it. So this is actually the all share price index from 2009 to 2024. I've shown you how the ASPI has performed, right? So you can see in 2009 it has been around 3,000 points range, and over the years how it has progressed. And last year we finished with about an index of 15,000 points. So why should you invest in equity, right? So firstly, it's for higher returns. There are two types of returns on equity. I will explain in the later slide because there is risk involved in it as well. And as a result of that, there is high return that you can expect out of it as well. And then secondly, it's high liquidity because unlike you putting money in a fixed deposit, it gets locked for that period of time, right? But whereas in equity, there is you can buy and sell shares whenever you want and you have your access to your capital. Tax exemptions, basically capital gains are tax exempted. Uh, and also you have the other advantage of investing in equities, you have the ability to diversify. So some people they are worried about the risk factor, right? So one way of how you can mitigate your risk is you diversifying it across different sectors, right? For an example, if I tell you if you take in the tourism industry, if it's picking up, a lot of tourists are coming to Sri Lanka, so you will think, you will feel that, okay, the hotel industry will do well. So you might invest in some hotel stocks, right? But all of a sudden, let's say some pandemic or something like COVID has come in and tourism drops and everything. So you can see that that industry is fully affected, right? So if you had put all your money into that kind of just only one sector, if something happens to that sector, then you are at risk, right? Which is why you need to diversify across different sectors so that you mitigate this particular risk. So in terms of the returns, if you take, so fixed deposit is what you and I are very comfortable on, right? But there is only one form of interest that you, one form of return that you get on fixed deposits, and that is just interest. And that itself is taxable right now. But whereas if you take in equity, there are different multidimensional forms of return. Firstly, there's something called capital gains, right? So what that means is if you buy a particular stock at 100 rupees today, that moving up to 120 or whatever in few months time, that difference, let's say from 100 to 120, that 20 rupees is your capital gain. And keep in mind that that is tax exempted in Sri Lanka. So you need not worry. So you're not getting taxed on capital gains. Next, I will talk about cash dividend. Cash dividend is where the companies, if they have made sufficient profit and if they have decided to share it among the shareholders, so you will be getting something called a dividend, right? So they will say per share how much they will pay. It could be 50 cents per share or 15 cents, 15 rupees per share. It is decided by the company, right? So while you are holding the stock, if that particular company that you have invested in is going to declare a dividend, that means you will be getting a return in the interim while you are holding the stock. Scrip dividend is the same as cash dividend, but here instead of cash, you'll be getting additional shares. So that's what you call a scrip dividend. And then there's something called rights issues. So what that means is companies sometimes when they want to raise additional capital, they would issue a rights issue where the existing shareholders will be getting additional shares on a discounted price, but it's up to them whether they would like to subscribe for it or not, right? But there are two options for them. Either they can sell their rights issues off the market and get funds, or they can subscribe for the rights, and after some time those additional shares, the rights shares, will be converted to ordinary shares. So these are some basic statistics as of now. So if you take the fixed deposit rate, the 12-month fixed deposit rate lies between 7 to 8%. The 12-month treasury bill rate. So basically, the treasury bill rate actually means the 12-month T-bill rate is actually the risk-free rate, right? Because those are government securities and short-term, and the return that you get on that is 8.35. So this 8.35 is said to be the risk-free return in the market currently. But like, if you see, as I told you, some companies pay out dividends. So especially companies like the tile companies, insurance companies, those companies are very dividend yielding counters, right? So for an example here, if you can say Valuable, Union Assurance, CTC, distilleries, if you look at their current dividend yield, some of them have outperformed than the 12-month fixed deposit rate. So here we have just done a small comparison between fixed deposits and bank stocks, right? So here you can see over last year we have taken commercial bank has given a return of 49.4%, HNB 88.1%, Sampath 67.3%, and FD is about 10.8% for the entire year. So what you need to understand is at times when the interest rates are like single digits like it is now, what people do is there is a relationship between the stock market and the interest rates. So when the interest rates are very low, what banks offering is low, what people try to do is they try to look into other investment opportunities, and stock market is one of them where you can get a higher return. So which is why we saw over the past few months a lot of activity, and it was like an all-time high in the Colombo stock market, was because people actually kind of shifted from putting FDs to they put those money into the stock market. So, but also you need to understand that the market is not always at an all-time high. So there can be ups and downs. There is always volatility, and that risk factor is always there, right? So I'm going to touch upon a few factors that cause stock market fluctuations. So basically, if you take the price of a stock, it is based on the demand and the supply for it. So if a lot of people want that particular stock, the price keeps on going up. When the demand is high, the price goes up, and then when they see uh, that stock has performed enough, and if people are kind of exiting that counter, they'll sell it off, so the supply will be high, and then the price comes down. So the equilibrium between these two, demand and supply, is the price of a particular stock. So this actually gets affected by many factors. So it could be due to company performance and announcements. So company performance, so basically all companies, they are supposed to put out their financials every year after the financial year, the audited accounts. And apart from that, they are supposed to publish quarterly results as well. So if a company has performed, a quarterly report comes out, and you see that the company's earnings have increased and earnings per share to all that, so then there'll be much more demand for that particular stock. You'll see a lot of activity in it, and people would want to buy it. Apart from that, announcements, let's say if a company is paying a good dividend, then people are very interested in buying that particular stock. Then industry developments, especially with the budget readings and everything, if there is a policy which helps a particular industry, if the tourism sector is supposed to develop, then people will invest more on hotel stocks. Then political and economic conditions, the best example that I would have to give you on this point is that somewhere in September, the all share price index came down to as low as 10,500 levels, because there was a lot of uncertainty into who will get elected, and people were not sure about whether the policies will continue, and there was a lot of sentiment. So after the presidential election, there was a lot of political and economic stability, and they agreed to go with the IMF guidelines. So with that, people actually gained more confidence, and provided that the interest rates were also like single digits, a lot of people pumped in money into the stock market, which is why we saw like a all-time high over the past couple of months. And again, the trader sentiment, what the overall people, like the stock market people who are in it, how they feel the sentiment. So if people see that there is a lot of selling in a particular counter, then people start to panic, and some people also sell with the flow, right? So that is how the stock market works. And what you need to understand is this volatility will always be there. But what you need not worry is, if you have invested in the stock with the right guidance and with the right research, and if you know about that company very well, you and that you have considered all your risks, you should not worry about it in the long term. So before you invest, you have to define your investment goal, right? You need to understand whether you're a short-term goal oriented or medium or long-term, right? So ideally, the stock market with the types of stocks that we recommend, if you're like a medium to long-term, I would say medium means somewhere between 6 to 12 months or beyond, right? If you're looking at a goal like that, then it'll be ideal for you to invest in the stock market. Then you need to understand your risk tolerance, right? What is your financial situation? If you have any upcoming financial commitments, let's say in a month or two, that type of money you shouldn't put in the stock market and expect a return in a month or two, right? So which is why I tell you that you need to understand the situation and invest accordingly. And then research and due diligence. So for all our clients, we make all our research content available, and you have your investment advisor to guide you, and we provide you with all the information. But what you need to do from your end is to just stay updated with the current trends, what's happening in Sri Lanka and globally. If I am to tell you an example, so currently we know that US has imposed tariffs on China, Mexico, and all. So what first, there are a few stocks that we recommend, where we say because there are import tariffs put on China, we expect the Sri Lankan demand to grow, right? So things like that. So that when the investment advisor explains to you, that you'll understand better if you know, if you are updated with what happened with the current affairs. And also you need to diversify your portfolio. You need to put across different sectors so that you mitigate the risk. And also you need to consider dividends to see, like if you have invested in a capital growing counter, on the other hand, it's better to invest in a counter that will give you dividend as well, so that you have two options. And also always you can review and adjust, right? So some people, if we ask them about the stock market, they would say they just had a bad experience and they'll just exit, right? But if you have been very patient and disciplined, right, so there can be times where you might even have to exit a particular counter at a loss, right? But it's important that you adjust and review it and adjust accordingly, because there can be times where you take a loss, but you will invest in something better so that you can get a better return. So all this is possible if you kind of take a medium to long term view with your investments. If you are very short term goal oriented, yes, definitely you will make a loss, because the market keeps on changing all the time. So you will always need to keep in mind to review and adjust where necessary. So this is balancing risks and returns at different ages, right? So if you are someone who is very young, then definitely you might not, if you're still not married or if you're still studying or something, you might be getting some income from your parents, or so you might not have big financial commitments, right? So in that case, you can actually invest in very growth oriented assets, and will give you higher returns. You can expect capital growth because you can lock in money for some time. If you're middle-aged investors, where you might be you might be having children, so you must be having some financial commitments, right? So in that case, it's better for you, what is ideal for you is to put a portion of your investment into capital growing stocks, as well as in the interim also to put an on dividend yielding counters as well, so that you balance it. Older investors, especially people who are retired, right? So some people must be relying on their interest or on their dividends, right? So older investors, actually, it's better that you prioritize to preserve your capital and get a reliable stream of income. So mainly the dividend yielding counters is what we would recommend for them. So the strategy is very simple. First of all, you need to explore, see what industry that you understand, right? With the trends and everything. So identify interesting sectors, right? Identify the local and the macroeconomic trends, and then let's say for an example, if I select a manufacturing company, right? So if I know with policy changes and the economy growing, if I assume the manufacturing sector, or in other words, I'll just take an example, let's say the construction sector. So with this political and economic stability, if we see like the halted projects are starting up, so then you could look at what are the counters in the construction sector. Then you need to evaluate each one of these, because every company is not the same. How they perform, how they allocate funds is different. So you need to understand the company, right? So you need to read company quarterly and the annual reports, which we will kind of like give you with a snapshot. So our research will work on every company. When they put out their financials, we do like a snapshot saying these are the quarterly results of this particular company, right? So you need to kind of see whether it's quarter on quarter, have they performed, year on year, is there a growth or a decline. So you need to just kind of look through these things, right? So, and also there are two types of evaluating a particular stock. There is fundamental analysis and there is technical analysis. Fundamental analysis means you go through the financial statements and see the financial strength of a particular company. And technical analysis essentially will look into the historic price changes, and through graphs they will kind of like understand a particular trend, and according to the trend they will be able to forecast and say this particular stock has a potential to go this much. So there's technical analysis and fundamental, right? So it's very so we will actually do our technical analysis as well. And just make sure that you always invest in stocks which are fundamentally strong. And next, after you have decided on what you want to invest in, it's a matter of fact of executing the order. So as I told you, when you are evaluating a particular company, so there are some key ratios that you need to understand when you look at a financial statement. You need not know each and every line item to say whether the revenue has increased. These are some key ratios that investors look into. So number one is the earnings per share. That is, it measures how much of earnings are you getting per share. In other words, measures the profitability per share. Then there is something called the price to earnings ratio, which means measures how much investors are willing to pay per rupee of earnings. So I've just to explain this, I've taken like a small example where there are two companies. We have company A and company B. So if you take the share price of company A, it's at 60 rupees, and the share price of company B is 10. Right? So from the look of it, some people would be like, oh, company B, it's 10 rupees per share. That's great. So you might see company A as very expensive compared to B, right? But what you need to look at is something like this. Now, for an example, if you take company A has got an earnings of 100,000, whereas B has made only earnings of 10,000. And how much of shares are in issue? Company A has 50,000, company B has 10,000. So if you take the earnings per share, basically that's the earnings divided by the number of shares in issue, right? So for company A, it will be 2 rupees per share, and for company B, the earnings is 1 rupee. So now you can see you can't merely go by the share price, right? Because company A is of a higher share price, but in terms of earnings per share, it actually gives you a better return than company B. Then to understand this, there is something called the PE ratio. This is actually given in a multiple, right? So that they consider the current share price, which is 60, you divide it by the earnings per share, it says 30 times. What this means is the stock is actually doing 30 times its earnings. The stock is more expensive relative to its earnings. So what this means is it could be two things, right? So if there is a very good fundamental story behind a particular stock, ideally what this PE would mean is that investors see much more growth potential in that company, right? So which is why it goes in a multiple of 30. right? But if it's a stock which does not have a growth story in it, and if it is at 30 times, then what you should understand is the company is overvalued, which means there is this intrinsic value and the market value, right? So in this case, if it's not a fundamentally strong stock and with a higher multiple like this, that means it's overvalued. So you need to understand, and always it's like a relative measure. You have to kind of look in with the industry and with the historical earnings. You need to always compare these. Whereas now for company B, it could be two scenarios. In terms of earnings, it could be relatively cheap to kind of buy this stock, but it could also mean that this company does not have like enough growth potential, right? So you always have to see it relatively with historic price information and also with the industry averages. Then there is price to book value is similar to the price earnings ratio, but price to book value is mainly used for the banking stocks, right? It also compares the market price to book value. Then we have dividend per share, so that actually measures the dividend or the scrip dividend paid out per share. Then there is dividend payout, how much the company, in what percentage do they allocate dividends out of their earnings, is the dividend payout. Dividend yield is as a percentage as opposed to the stock price. What's the annual dividend as a percentage of the stock? And also you need to understand about the cost component through this. So basically there now for you to start up that 50,000, as I mentioned, that is not like a charge or anything, that is purely for you to invest in the market, right? So the only cost that gets applied through this whole process is this 1.12%, which gets applied each time you trade. There'll be 1.12% of charges. So basically, this 1 to 1.12% is a makeup of the brokerage fee, CSC fee, CDS fee, SEC, and the share transaction levy. So all these percentages together is this 1.12%. So for an example, if you purchase a particular stock at 100 rupees, your actual cost is 101.12 is what you need to understand. And even when you're selling, if you're selling it at 100, they will always deduct the charges and only credit it to your bank account. So then it's 98.88 is this price. So if I am to brief you all on how the account opening process takes place, it's done. It's fully digitalized, so it's done through the CSE mobile app. You have to download this, and first of all, you need to register yourself with your email address and mobile number. Afterwards, there is an option saying our services open CDS account, and CDS always makes their main source of identification is the NIC. So you need to fill in all your details according to the NIC. In a situation where your address is different to what is said in your NIC, then you need to give some billing proof, which is within 3 months period. And also we need a bank statement, because whatever the dividends that you get, the company secretaries will directly credit it to your bank account that is designated, and any sales proceeds also will come to the banking details that you provide. And we also enable all our clients with online trading platforms. So it's purely on cash basis. So whatever the amount that you put in would be your buying power. So the online trading platform will help you to get market data. You can customize the app in a way that is suitable and comfortable for you. You can monitor your portfolio. So basically, that in a dashboard, it will show at any given point with the current market price any stock that you performed, whether you're making a gain on it or a loss on it, and what percentage. So in a snapshot, you can see how your portfolio is doing. So in a situation where you see you feel like you have enough return, you need to exit it, you can quickly trade and enter your own trade. Or if it's if you're kind of busy or anything, you could ask your investment advisor to trade as well, right? So the trading is also not a very difficult thing. Make sure to get right recommendation and the proper guidance. Know what stock that you're going to invest in, and then it's just a matter of fact of entering what stock you want to buy or sell, what is the quantity and what is the price, and or enter the order. So in this day and age, all of us are very comfortable doing a online banking transaction. So this also, once you get a hang of it, it's not a very tedious task, right? And to support you with that also, we have an online trading guide, which is like a step by step approach to assist you with it. And then it has the feature of creating a watch list as well. That is where any stock, so there are 284 stocks listed on the CSE, but it's not that essentially we are interested in all of it, right? So maybe we want to see the construction sector uh, counters, are they doing well these days? So for you to do that, you can pick and choose what stocks you want to watch closely or monitor. So that's what you mean by creating a watch list. And also, if you're like a very busy person and you're unable to kind of like keep a tab of the market all the time, it also has a feature where you can set up a price alert, right? So basically, when in our recommendations, when we say there is like a price that we could forecast it to be based on its earnings and based on its fundamentals, right? There is something called a fair value that we can gauge through the company's performance, right? So if it comes closer to the fair value, you can set up an alert where you will get notified when it's coming closer to that price, because after the fair value, it's better to exit a particular counter. And so, why should you choose John Kay Stockbrokers? It's mainly for reputation and credibility. So, you need not worry about your details or anything that you need, any guidance, the level of service, and investment research. So, we are very strong on our research content. We do a report called the Market Strategy, which is done by annually, where we do like a detailed report on the stocks that we recommend for you to understand what is the logic behind it, why have we recommended it, right? And apart from that, we will give you like a snapshot of all the quarterlies and all the details. And regulatory compliance, so all the stock brokering firms, this entire industry is in a highly regulated environment, so we need to go abide by the rules. So you need not worry about the transparency of your transactions or anything for that matter. And also we will enable you with mobile accessibility and user friendly platform. So the online trading guide is there for you to support, so you can have it on your desktop or on your laptop, or you can have it on your phone, and it's a very user friendly platform. So with that, I'm done with my section. So if anybody is interested, right, irrespective of whether you want to be a client of us right away or maybe in some time later or whatever the case may be, the QR code shown on screen is our WhatsApp channel. So for any updates or anything, if you would want to follow, you can scan the QR code and join our WhatsApp channel. And apart from that, most of the information that I shared or the frequently asked questions and things like that are covered on our website, which is www.jksb.com. And we do have a designated landing page for She Invest as well. If you want to be in touch with us, if you want us to speak to you and help you out with anything, and also the progress that we have made through our campaign, all these details are shared on the landing page, and my number is also there on screen. So if anybody wants any assistance, or if you want me to explain anything further, you can reach out to me on my number as well. So with that, I can wrap up my presentation, and we're open for questions. If anybody wants to ask us anything, just please drop a message on the chat. Okay, so Kavi has asked, when you look at a company's financials to invest, what are the factors or numbers that you should look at? So, as I told you, it's the ratios, like how much are you getting per share, what's the earnings per share. You need to understand. So basically, when we give the quarterlies, we give like a snapshot saying this is the price earnings ratio, this is the EPS. So at a glance, you would know, and you can compare it with the previous quarters, quarter on quarter, as the EPS grown. Is the price multiple uh, better now or with the industry average? Now, for an example, if you take the overall stock market, it's currently trading at around 9 times, right? But what in a single interest rate regime, usually it has more potential. So what we believe currently is now the overall market is also undervalued, right? And especially these days, the market is also down, which is also a good time to enter into the market as well. So, in terms of to answer your question, when you look at the financials, it's good for you to see about the dividends, the earnings per share, what is the multiple, the PE ratio, right? Is it overvalued, undervalued? So, these are the types of things you need to ask your investment advisor. Is there more potential for this company to grow? How much do you expect it to be? What's like the fair value and things like that? And also, she had asked if we could share this deck. Yes, we do have all your details, so we will send across an email with this recording as well as the deck. Anybody else with any questions? Okay, so in the interest of time, I'll just keep my number on screen for some time. So if you want to reach out to me, please feel free to call me and I'll assist you with anything. And I hope this session was a very uh, useful session in terms of enhancing your knowledge and for you to get some confidence in investing in the stock market. Thank you very much.